All right. Well, good morning. Welcome. I'm Sean Gould, partner and senior wealth strategist here at Waddell and Associates. Thank you all for tuning in. It's been a turbulent few weeks in the market. There's been a lot of media buzz. Many of you have been reaching out with questions about what to do, what to expect, whether we're heading into a recession. Our CEO and chief investment strategist, David Waddell, will dive into this and provide a Taylor Swift inspired update to the current economic, political, and market conditions and share our expectations for the rest of the year. For those of you joining us for the first time, Waddell and Associates is a wealth strategies firm dedicated to enriching life by providing clarity. Our host, David Waddell, is often featured as an expert on CNBC, Fox Business, Forbes, the Wall Street Journal, Barron's, and many more. Feel free to use the Q&A area for any questions you have during the presentation. David's going to do his best to answer as many as he can at the end. If he doesn't get to yours, we will get an answer to you after we sign off. We are recording this presentation and we'll send out a replay in the next few days. It will also be available on our website at www.wealthstrategists.com. All right, with that, let's bring on David and kick things off. The 2024 halftime report, a swift survey of economics, politics, and markets.
Good morning, everybody, and thank you for clicking in to this, our 2024 halftime report. Good news, as we predicted in our 2024 outlook that we delivered back in February, investors have built a substantial lead in the markets over the first half of the year, but the second half schedule gets a little bit more challenging as long and variable lags threaten the economy, as the election season challenges the national psyche, and as Federal Reserve policy decisions threaten our first half gains. So the real question now that we've completed half of the year is, will investors build upon the first half gains and increase the lead going into year end, or will opposing defenses force a fumble? That is the right question to ask, and we will endeavor to answer it for you here. We have a lot of field to cover, and so let's begin. If you recall, back at the beginning of the year, I titled our Outlook presentation, Why They Gotta Be So Mean. And the reason I did that was because, as you know, at the beginning of every year, I go into hiding. I read everything I can get my hands on. I do a lot of thinking and try and figure out where we're going to go in the year ahead. And while I was doing all of that work, the song Why They Gotta Be So Mean kept recurring in my head. Now, it could have been because it was my daughter Sailor's favorite song when she was younger, and hearing it makes me super happy. But most likely it was because after 4 years of COVID craziness, I really just wanted the economics, the politics, and the markets to calm down. It had been exhausting trying to research and forecast all of these oppositional forces in an environment of heightened volatility. And I thought, wouldn't it be nice if everything just reverted to the mean? So in preparation for that presentation, my goal was to assess the probability that the world returns to average back in 2024. Well, before we begin, we do need to revisit our statistics class with Taylor Swift, who's here showing you a traditional bell curve. Recall that that's just a distribution from a data set around average, also known as the mean. And 70% of outcomes in a traditional bell curve typically occur between one standard deviation positive, one standard deviation negative, and that's a world that feels somewhat composed. Obviously, we've been living in a world that didn't feel all that composed. 4% of outcomes in a standard deviation or in a traditional bell curve occur 2 standard deviations out on either flank. That's the world we've been living in. That's what made me want so badly to return to the mean. What caused this? Well, in the United States, we had over 100 million COVID cases since 2020, which led to, forced economic closures. It led to millions of deaths. It was obviously a horrible event, but it created this crazy histrionic environment. And that included, 15% unemployment right as COVID hit and the economy shut down, which then fell down to, a 40-year low at 3.5% unemployment. We saw a 0.5% 10-year treasury that instantly sort of recovered into a 5% 10-year treasury, which we hadn't seen in a long time. We had 0% inflation that surged up to 9% inflation on the back of all the stimulus. We had 0% Fed funds as we were trying to goose the economy. And then we got 5.5% Fed funds as we were trying to slow it down. We had political riots in our major cities. We had political riots in our capital. We had bonds falling 20%, which they never really do, only to recover up 15% off their lows. And then we had stocks falling near 40% into the COVID craziness, and they've rallied about 140% through yesterday's close since then. It's been a wild roller coaster ride, and clearly it's been haunting to Taylor. So the question now becomes, will the histrionics that we've seen in that post-pandemic period filter into the second half or into 2024 as a whole? And to answer that question, we have to do a swift survey of the halftime economy and talk about where we are at this current moment. Well, remember last February when we did our Outlook presentation, we outlined 3 possible scenarios for the economy this year. First, we talked about a potential hard landing where GDP shrinks, inflation grows at less than 2%. Essentially, that's a recession. That's bad for workers, bad for investors. And then we talked about the no landing scenario where GDP would grow faster than trend over 2% and inflation would continue to be persistent above 2.5%. And while that may sound like a good outcome, the reality is by doing that, you bring the Fed into play to try and slow the economy down. Maybe they make a policy mistake. We end up being in the hard landing scenario. We end up in a recession, which is bad for workers and bad for investors. What we really wanted coming into this year, and frankly predicted, was that we'd have a soft landing. That GDP would come in, right about trend, call it 2% or around there, and that inflation would indeed fall back or disinflate back to 2 to a 2.5% growth rate. Good news, that's exactly what's happened. So we have in the first half of 2024 achieved a soft landing. I don't have an applause button, but if I did, I'd certainly use it. The question is now going forward, can we continue within that soft landing or are we pivoting one way or another? So that's what we're going to talk about now as we look forward. This is the Federal Open Market Committee of your Federal Reserve. And right now, they have the football. They've achieved the soft landing. Now the question is, will they cut or will they not cut rates? And I'm pausing here for a second because I just want you to get a feel for what it's like to be on this committee. Lots of smart people, lots of big egos, lots of input, a pretty raucous room at a time like this. I'll come back to that. All right, so we're sitting at the table at the FOMC and somebody pounds it and says, we can't cut rates. And we can't cut rates because we've told everybody that our target for inflation is 2% and our core measure of inflation, our preferred measure, is at 2.6%. Therefore, no cuts. So let's just stay mean. What does that mean? Well, we leave rates at 5.5% where they've been for a year. We use quantitative tightening to withdraw $65 billion a month of liquidity from the system. We remain restrictive. And then there's Jerome Powell, who is the only person, by the way, on that committee who's ever had a paying job that required him to predict the future. He invested money, had to look at companies, forecast earnings, have a forward-looking posture. I would argue everybody else at that table who's data dependent has a backward-looking posture. So this is probably what's occurring in Jerome Powell's head. First of all, the Fed has been on red, as I've said. So they maintained an accommodative stance in their monetary policy up until the end of 2022, and then they moved into a restrictive policy stance at that point and have remained there ever since. And the idea there is to slow down the economy, which would, of course, slow down the rate of inflation growth. And they call that slowdown of the economy as a result of tight monetary policy, long and variable lags. So here is GDP growth in the US prior to the restrictive policy regime. During the accommodated policy regime, we were going at 3.25% on average. That was great, but if trend is 2%, that's a little hot, and it called the Fed to be somewhat more aggressive. So they raised rates. They started their quantitative tightening. They moved us into a restrictive policy regime where we are today. And since they did that, GDP has come down to 2.75%. But if you removed the Taylor Swift impact from the third quarter and the fourth quarter, we're really right at about 2%. So restrictive policy has done its job. The US economy has slowed. And if you take inflation without housing involved, it's actually below target. So we're at 1.8% on core inflation without target. So we've got growth back at target, basically. We've got inflation back at target. The question now is if the Fed maintains this tight posture in policy, will they force a fumble? And those of you who are Eagles fans will appreciate this, but for the purposes of the presentation, we're really rooting for Travis Kelce. So the Fed can come in, they can tackle Travis, Travis can fumble. That'd be bad for workers, that'd be bad for investors. So let's look at my favorite fumble forecasters and figure out where this economy really stands and how resilient at this moment is the economy. So this is the yield curve indicator. You've heard a lot about this for a long period of time because the yield curve has been negative for a long period of time, which has a lot of traditional economists scratching their head. And the reason why the yield curve being negative is a problem is it puts a lot of pressure on the banking system who have to pay high rates for short-term deposits only to receive low rates on the loans that they extend. And so what we're looking at here is how many bank failures you've seen by year going back to 2001. Obviously, during the great financial crisis, we had a ton of bank failures. We had 5 back in 2023. A lot of people don't consider that a financial crisis. Don't count me as one of them. If you look at those 5 banks and you total up the assets and look at just asset size, therefore, of the failures, it was $549 billion in 2023, compared with $374 billion during the highest year of the great financial crisis. So we had a financial crisis in 2023. And typically, a financial crisis causes a recession, which is why when the yield curve inverts, you have a financial crisis, and then you have a recession. But in this instance, the Fed stepped in, and the Fed stepped in a big way. They learned a lot from the great financial crisis. And from this slide, these numbers actually are bigger, but the amount of emergency assistance that they deployed quickly in 2023 to stem that risk of contagion and financial crisis was more than they did in any year during the great financial crisis. So the Fed came to the rescue, crisis averted. But that's not the only victim of an inverted yield curve. You've heard a lot about commercial real estate. Is it possible that commercial real estate goes into crisis because the funding levels on projects are high? They have to pay more to restructure their loans. The restructuring costs are high. So are we on the cusp of a commercial real estate crisis? And will that, in fact, infect the banking system, putting us back into a financial crisis? Maybe the Fed responds to it. Maybe they don't. Well, when we're talking about commercial real estate, we tend to lump it all together. Let me segregate it out a little bit here, and let's just look at vacancy rates. So if we look at apartment vacancy rates right now, we're basically where we were pre-COVID. So that gives people that own the apartment complexes the opportunity to raise rents pass inflation forward and pay higher interest costs. So apartment owners should be fine. Industrial owners, thanks to reshoring and stimulus and data farms, they're doing fine. Vacancy rates have stayed the same. Some instances, they're actually below where they were pre-COVID. And so they're fine. So apartments are fine, industrial's fine. Retail is actually fine, except for the city centers, but that data wasn't meaningful enough to share. So let's talk about office. Office now, 20% of office out there is sitting vacant. That's putting a lot of pressure on people who own those properties to refinance, putting a lot of pressure potentially on community banks who supposedly own all of this debt, according to the media. The question is, do they really own all of this debt? Well, we'll get to that. First, let's size the amount of debt out there that needs to be restructured, repriced, or extended. So we've got $1 trillion worth of commercial real estate loans that will mature in this year, in 2024. That drops to about 2025 next year. Should all of that reside within community banks, then yes, perhaps a bunch of defaults could create pressure on those community banks that haven't sold that stuff off, therefore creating a contagion, therefore great financial crisis number 2. It's a catchy narrative, and I see it on the X or the Twitter or whatever, but here's the reality. The commercial real estate debt holders, 12% of all of that is in the top 25 banks. Not a ton, but a significant portion. 14% is held within 125 regional banks. When we get to community banks, across 4,555 community banks, they hold 13% of the total commercial real estate debt outstanding. And then 61% of this paper has been sold off and it's in the diaspora. So it's possible that you could have defaults within commercial real estate that put pressure on the system, but in reality, it's pretty distributed. And community banks themselves really only have 13% of the exposure. They would have to go into default. They've got a whole lot of other things on their balance sheet. So I don't really see, and it's taken me a while to get here, but I don't really see a community bank crisis coming from some sort of extend and pretend maturity wall that has hit the commercial real estate business. So I don't think we have a crisis here. If we do, though, does the Fed jump in? They've gotten pretty good at it. So crisis might be averted again. This is kind of a fun one. I don't know if y'all noticed, but we had a whole bunch of disruption in the market just last week. And it's because central bank policies really do matter. Evidence of that. The Bank of Japan made a policy mistake, and because of that, it ricocheted to our shores over here and caused a whole lot of pain for investors only a week and a half ago, which really turned out to be a buying opportunity as we did inside Waddell & Associates. But let's take a look at this carry trade, because I think it's really important to understand the mechanics and how much of a risk that might be to investors in the second half. All right, here's how the carry trade works. We're traders. We go and we borrow a whole bunch of money in Japanese yen. And for the purposes of this illustration, we're going to do it on January 1st. So we're going to go out, we're going to borrow a bunch of yen on January 1st. We're going to take that yen, convert it into dollars, and then we're going to buy the Magnificent Seven stocks because that's all everybody wants to own. Well, great news. Over the course of our holding period between January 1st and July 10th, the Magnificent Seven stocks have gone up 50%. That's great. And we didn't have to pay much in interest expense because the interest rates in Japan are so very low. Better yet, when we close out our trade and we pay off our yen loan, remember we have to sell our dollars and buy yen, well, the yen's depreciated 13%. So this is a 60% spread on this trade before applying any leverage. So let's say we applied 50% leverage, we've doubled our money in the first basically 6 months of the year. What a merry carry trade. But what if it goes wrong? Well, let's do it from July 10th to August 5th, basically. So we do the same thing. We go borrow a bunch of yen. We convert it into dollars. We buy the Magnificent Seven stocks. Stocks have gone down 18%. in basically a month. Well, that puts a lot of pressure on us. And if we've levered, then it may call the banks to call us and say, hey, we need our money back. Well, okay, we'll pay you our money back. We go to close out the trade, except the yen has appreciated 13%. So now we're 30% or so upside down in this trade. If you apply leverage, it's double that amount. That could create significant pain, if not prove catastrophic, which is what happened to this guy in 1998. So those of you who love market history will recognize that this is John Merriweather. He was a brilliant guy at Salomon Brothers, had made them a lot of money, spun out with Myron and Scholes and created long-term capital management. They did the carry trade, only they levered it up 25 to 1. So they had 25 dollars worth of notional value for every $1 they actually put into the system. This was an extreme amount of leverage. And when the carry trade moved against them during the Asian financial crisis, they had to liquidate their positions. It put so much pressure on the markets that 14 banks had to bail them out, including the US Central Bank cutting rates. And so markets are smart. They realize the carry trade's probably pretty big, and somebody like this is probably getting murdered. And so this is something we should be very nervous about. And in fact, this is how nervous the market was. This is a chart of the volatility index going back to 2004, which is a fear gauge, if you will, within the equity markets. You can see the yen carry crisis led us to the third highest level ever on the VIX index, third only to the global financial crisis and the COVID crisis, much greater than the euro crisis. So the market was in a state of panic. But here's the thing I want you to remember, and I keep reiterating this because sentiment matters so much. Pessimism pays. So here's what happened after the VIX reached each of those peaks going back over those last few episodes. A year later, after the VIX hit, whatever it was, 85 during the great financial crisis, the S&P was 21% higher. A year after the VIX spiked during the euro crisis, the S&P was 25% higher. A year after the VIX spiked during the pandemic crisis, the S&P was 66% higher. What's going to happen after the yen trade, the VIX spike during the yen carry crisis? I don't know, but I'll tell you this, it's already 8% higher. So anytime you see that extreme level of volatility and fear in the index, buy it, or just hire us and we'll buy it for you. All right, let's talk about now another fumble forecaster that's a favorite of mine, negative leading economic indices. Now, this is something that the Conference Board puts out monthly, and it has a very good track record of predicting recessions. And the LEI has been in negative territory now for an extended period of time and continues to be based upon the reading in June. And you can see, hopefully, on your screen, the gray bars, the LEI goes negative, and soon after, you see the gray, which is indicating recessions. That has not happened in this time period, though, which has confounded some economists. Well, here's why. The LEI index concentrates specifically really on the manufacturing sector, and the manufacturing sector in the US has basically been in recession for almost 2 years. Any number below 50 in this index, and this is the ISM Manufacturing Purchasing Managers Index, indicates contraction in the sector. It's contracted 20 out of the last 21 months, including the last reading. We got a very soft reading for manufacturing this morning, in fact. So we've been in a manufacturing recession here in the United States of America for quite a while. But it's important to understand the composition of the US economy. The US economy today is only 22% manufacturing. We are a services economy. 78% of our economic activity come from services, not goods producing manufacturing. So let's take a look at the services side of the economy. Well, the services ISM Purchasing Manager Index has been above 50 for 47 out of the last 50 months. And so we've really been in a dramatic services expansion, people using money to have experiences and eat out and fly on planes, and a lot of that was stimulus money. Whatever the backdrop, whatever the instigation, we've been in a great service expansion. However, Services did turn negative in June. And while we popped a little bit higher in July, there's still a downtrend here. And if I was Jerome Powell, I'd be thinking hard about that. All right, let's look at my favorite fumble forecaster and the one that we highlighted in our Outlook presentation this year. What is going on with the housing market? Well, before we talk about that, let's talk about the construction of the US economy and how it's structured. 3% negative of GDP, 28 trillion in GDP, comes from the fact that we import more goods than we export. A lot of people have opinions on that. We actually, because we import more than we export, we actually import more capital than we export. That's a good thing. The US is a really attractive place for people to put money. That finances our deficits, et cetera. So all this stuff's intertwined, but that's a whole nother presentation. All right, 70% of the US economy is consumption-based, us going out and buying stuff. 18% or 17.5% really is government spending. That is your friendly government spending money on your behalf. And 14% is corporate spending, basically ex housing. And while housing is only 4% of the total stack directly, it is the best predictor of oncoming recessions. And so here's a chart that really has become one of my favorites. This shows the contribution of residential investment to GDP growth 2 quarters before each of the last 8 recessions. As you can see, in the 6 months before the US economy actually falls into recession, housing has started to significantly deplete GDP growth because housing is the most interest rate sensitive. So if you're really looking for evidence of long and variable lags, you want to look at housing. The good news is, up until this point, housing has contributed to GDP growth. So when we talked about this back in February, this was a very positive indicator and one of the reasons why we expected the economy would continue to grow throughout the year. However, in the June GDP report, we did see housing actually detract slightly from GDP. And we've also seen a downturn in housing starts. So if I'm Powell, I'm a little bit concerned about what's going on with the slowdown in the services economy. I'm pretty concerned about what's going on with the slowdown in the housing economy. And even though all my backward-looking buddies are telling me, you know, inflation's too high, if I'm forward-looking, this gives me pause and some concern. My last fumble forecaster, which also sort of pulls through the impact of long and variable lags, is rising unemployment. This chart's keeping me up a little bit at night. And so if I have one thing to worry about, it's kind of this. Here's why. Anytime you have seen the unemployment rate inflect higher by the degree where it's inflected at this moment in time, we have seen recession. So we have gone from 3.4% unemployment to 4.3%. Now, 4.3% is fantastic. And if we could just stay there, that would be the best case scenario. But again, I think that's predicated on proper policy decisions from the Fed. Okay, there are some on the Fed who will say, hey, Jay, the labor market is strong. We currently have 1.2 job openings for every unemployed worker, which is where we were pre-pandemic when things were all good. And Jerome would say, yes, that's true. But if I look at the trend, and these were words he used, I think, before Congress, the labor market seems to be cooling considerably. Now, fortunately, if you look at the labor market, and we got a benign number this morning, layoffs remain very low. So even though job openings have ticked a bit lower, we haven't really started to see layoffs. In fact, this morning's jobless claim number was very encouraging and lower than people expected. And that's why overall, economists really see a low probability of recession over the next 12 months. But the economic data is coming in below expectations in aggregate. So this is the Citigroup Economic Surprise Index, which I track pretty closely to figure out whether the economy is outperforming or underperforming expectations. And it's been negative here lately. And if I'm Jerome Powell, I'm also thinking about that. Now, the Fed is, as I said, backward looking and data dependent. And let me share some evidence on that. This is a great chart. So Nicole, good work on this. Thank you for it. This is the last 4 quarters of what they call the Fed dot plot. So every quarter, Fed members anonymously put onto a grid where they think the federal funds rate should be by the end of the year. Okay, and that looks forward. So what we've seen is sort of a migration of their opinion of growth and inflation over the last 4 quarters, looking into the end of 2024. In their last meeting, which was June 12th, they actually increased the level that they expected the interest rate to be at by the end of the year to 5.1, which would only imply 1 cut to interest rates by the end of the year. So between March and June, they saw an acceleration in growth and they saw an acceleration in inflation risk, which seems to me just a little bit tone deaf. Markets are outlook dependent. That's where we operate. And looking at the totality of the data, the markets are now baking in probably a little less this morning because we got a good retail sales number, but the markets are baking in 4 interest rate cuts by the end of the year, not 1, and 8 cuts over the next 12 months. Why is that? Well, right now the Fed has their policy at 5.5%. They have told us that neutral is 3%. That's 2.5% lower than where we sit today. If GDP is at trend, if inflation's at trend, then why hold the interest rate 2.5% above trend? So the Fed is clearly, in our opinion, behind the curve. And some say the Fed won't cut rates because the Fed doesn't do politics. This is also not true. So here's the movement of the federal funds target policy rate. And here are elections going back to 1984. Bush versus Dukakis was the first one. You can see rates change. And you can see, obviously, like Bush Kerry, they were raising rates dramatically. Trump Clinton, Biden Trump, they'd cut them. So anyway, the Fed doesn't do politics. That's a red herring. It's not true. The Fed will cut rates. It's a question of how much. And we can debate that in the Q&A if you'd like. All right. So there is an election upcoming in 2024 between between Vice President Kamala Harris and former President Donald Trump. And according to the media, democracy is at risk. If we get this wrong, it's the end of the United States of America. Well, if that's so true, maybe that would show up in the investment returns. So typically in election years, market advance about 8%. This year, in 2024, the record weirdness of the election season also happens to have accompanied record gains for the stock market for the first half of a presidential election season, where the S&P rose about 15% through the end of June. So record weirdness, record gains, just add it to the strange. Where are we now in terms of politics? I pulled these numbers this morning from Real Clear Politics. We're basically deadlocked in the polls. Harris at 47.9, Trump at 47. Obviously, Trump had a much wider lead when Biden withdrew. And since then, Harris has really caught a whole bunch of tailwinds from media goodwill, but voter enthusiasm as well, I suppose, being sort of unenthusiastic about Joe Biden. So the polls are deadlocked. But here's the question, really, and I get this one a lot. Does it really matter who's president? Well, this chart goes back all the way to Herbert Hoover. And what it shows you is that the US economy has grown under every single one of those presidents, including Donald Trump, including Joe Biden, back to the Great Depression. So the economy tends to grow despite who's in the Oval Office. What about the stock market? Well, here's what happened with the Dow Jones Industrial Average over Donald Trump's term, up about 70%. Here's what's happened during the Biden term. The term is still continuing, but at this point in Joe Biden's terms in office, the market's up about 45%, which is kind of right where it was during the Trump administration at this time. So markets can go up whether it's a blue or whether it's a red, chair in the Oval Office. And, if we think about it, it's not just the president, it's Congress as well. And really, the House of Representatives is the one that makes a lot of the financial decisions. And so if we go back and look at history and say, what are the most likely combinations of the president and Congress in 2024, 2025. If it's a Democratic president and a divided Congress, on average, the S&Ps advance 15.7% a year. If it's a Republican president and a divided Congress, on average, the S&P 500 has advanced 13.7% on the year. And if for some reason it's a Republican sweep, then you end up 13% on the year. So the most likely outcomes in November have all produced very sizable returns for investor, no matter who's obviously sitting in the Oval Office. But that doesn't mean that this investment environment is going to be worry-free. This is the VIX index we talked about earlier, and I've done a trailing history here during presidential election years. And as you can see, anxiety tends to build in the markets between mid-July and election day, and then tends to subside from there. So it doesn't mean that this is going to be a worry-free experience for us as election season heats up. But if the market does sell off, which it typically does by around 14% in a presidential election year, I need you to shake it off, because from that point over the next 12 months, the market on average gains 24%. So during the flash crash, from an intraday perspective, we had a 10% drawdown. Will that be the low for the year? I don't know. But if it is, we're on our way, I think, to substantial gains. If it's not, we go back and revisit it, and then we're on our way again to substantial gains. So our prediction for 2024, despite all of the hand-wringing, is that democracy will probably prevail. Now, the question is, will investors prevail? Well, this is extremely important and helped frame our optimistic outlook for 2024 overall. When you look at U.S. returns during economic expansions, 4% of the time, you see declines of at least 10%. 86% of the time, you see positive returns. 63% of the time, you see returns of 10% or greater, which is great, and it makes Taylor very happy. So let's go back and look at first equity returns to see if that indeed was the case in 2024. Well, clearly it was. So the Russell 1000 growth was up about 18% in the lead, the S&P 500 index about 15%, but some of you keen market observers will say, David, NVIDIA was 30% of that, and you're right. Okay, so NVIDIA played a huge role in the gain in these major indices as it continues its stratospheric rise. But even if you take NVIDIA out, the average return across emerging markets, value, the mid caps, small caps, the equal weight was 6.5%, which is still above average and clearly on its way to being more than a 10% plus total rate of return. So this bull has been fierce. Up until June 30th, we saw 34 new highs in the first half of 2024. But some people feel like they get a little altitude sickness when they see those kind of things. So question is, has this bull run too far? Has this bull run too fast? Well, here is a mosaic of previous bull markets to give us a little sense of where we are. The median gain for bull markets going back 100 years or so is about 90%. The median duration of a bull market is about 31 months. Where are we currently? Well, we're up about 55%, so well short of the 90, and we've been advancing for about 22 months, well short of the 31. That is simply the median going back to 100 years for bull markets. So this bull has not run too far. It has not run too fast. It's still got more to go. So I get some questions on this too. Are valuations too high? Well, that's a good question, but which valuations are you talking about? So this is the S&P 500 and the forward PE ratio, and you can see the 30-year average for this is about 16.7, and we sit today at 21 times, which is pretty high. It's above one standard deviation, which is about 20 times. But if we disaggregate the S&P 500 into the 10 largest companies and the remaining 490, the picture changes a little bit. So here's the PE for the top 10 companies at 29.3, obviously at the high end of its historical range. And here's the PE of the other 490 at about 17.8 times earnings, which is sort of right in the middle of its historical range. So while some stocks may be overvalued, the vast majority really are not. And the size of these top 10 stocks has really distorted returns. So the top 10 within the S&P right now account for 37.5% of the total capitalization within the index. And they also represented 73% of that 15% first half returns. Really outsized returns, outsized sized stocks. And some of this has been justified across the Magnificent Seven by their magnificent earnings growth. So the Magnificent Seven produced 34% earnings growth in 2003, 28% or 29% in 2004, and 18% forecasted for 2025. That is pretty magnificent. But because their earnings growth has been so magnificent and their investment returns have been so magnificent, they have sucked up all of the investor attention and left other areas of the market really, really cheap. So here are small and mid-cap stock PEs relative to the S&P 500, and you can see it's about 6 times lower. So just to put math on that, the current PE ratio of the S&P, as we've talked about, is 21. A longer-term view gives us a 15.7 on average, so obviously much higher than average. For the S&P 1000, which is the small and mid-cap stocks, we're currently trading at 14.7 times against a long-term average of 15.9 times. So large-cap stocks overvalued relative to history, mid-cap stocks undervalued. And here's what could unlock performance as we move down the cap spectrum. While Magnificent Seven earnings have been magnificent, some of that magnificence is now spreading. So here's what the S&P 493 earnings growth rate looks like, 23, 24, 25. And here's what the small cap Russell 2000 growth rate looks like, 23, 24, 25. So we're seeing a hockey stick and an acceleration of earnings growth beyond the Magnificent Seven, which means beyond just the S&P 500. And this is not just a local phenomenon. This is happening offshore as well. So here are annual earnings growth and expectations for the US, Europe, Japan, and the emerging markets in 2024. We're higher. In 2025, we're higher. And there's the same story there where the forward PE ratio on the S&P is higher than its long-term average. In Europe, it's lower. In Japan, it's about on it. And in the emerging markets, is lower as well. So that earnings push that you're seeing down the cap spectrum and offshore can be acquired for valuations lower than long-term averages. That's pretty attractive. And where is this coming from? Well, I think it's because of the adoption of advanced technologies. I know AI is in its initial stages, but just to give you a sense of how big a deal AI can be, this chart's a little busy, but it comes from Accenture, and they say, if you use AI in your business per sector, how much larger will your profits be by 2035? And overall, for the economy, they think that full adoption of AI could boost profits by another 40% by 2035. Well, that seems fantastical. However, if you look inside the S&P 500 quarterly net profit margin summary, we are headed towards record highs, and within the next 12 months, we're expected to punch through them. So you would expect if AI is really, as sold, that it would expand profit margins, and we're actually seeing that and could see that accelerate. Now, that gets pretty exciting. Corporate balance sheets are flush with cash. 6% of corporate balance sheets are in cash relative to the long-term average of 4.5%. That's plenty of money for new funds to come into the market through corporate buybacks. There's also plenty of money on household balance sheets. So if the Fed were to cut rates by 2% over the next 12 months, your money market fund would no longer yield 5%, it would yield 3%. If the market's ginning out 5 to 10% returns, my guess is you'll be tempted to go back in. And right now, as a group, households have 1.8 trillion stashed away in money market funds that can be used to buy into this market. So what happens to bonds when the Fed cuts rates? Fed's getting ready to. Should happen on September 18th. I hope so. Birthday's on the 21st. That'd be nice. Short-term bond investors after 6 months are 3% higher, 7.2% higher after a year on average. Intermediate-term bond investors nearly 5% higher. A year later, 10% higher on their holdings. And then long-term Treasury holders historically have been 5.5% better off in 6 months, 12.7% better off over a year. What about stock market investors like us? Well, large cap investors 6 months are 9.5% better off, 15.6% higher a year later. Mid cap investors, remember they're cheaper, 12.4% better off after 6 months, 22% higher after 12. And then small caps, which everybody says you don't want to own, they're terrible, they're left for dead. By the way, they're up more than 2% this morning. We're up 14.2% over 6 months and 27% a year later, which you can see informs our tilt sort of towards small and mid-cap companies. All right. Remember that what gave me comfort that this market could run this year was how pessimistic Wall Street was coming into the year. So we built a bell curve from JP Morgan's projection for the S&P at 4,200 on the low end to Ed Yardeni's projection of 5,400 at the high end, and said, based upon the Wall Street forecast, what is the average expected rate of return for the S&P for 2024? It was 2%. And we would close the year at 48.75. Well, we thought that was far too pessimistic, because if you adopt our belief that the economy will grow in 2024, and you do the work to know that in a growing economy, 63% of the time, markets outperform 10%, and you go back and look at the bell curve of historical market returns, you see that it leans decidedly to the right, meaning you're much more likely to see a year when the market's up 20% or more than you are to see a year when the markets are up between 0 and 10%. So this informed our bullishness. Well, I'm happy to say some of the other strategists are starting to come around. So initially, this group of strategists told us 48.75 by year end. Then they revised their target to 54.35. Okay, they're getting more bullish. Should that make us nervous? Still below where we closed at the half, which was 54.60. And as of this morning, we're well above another percent higher than that. So Wall Street is still undershooting, which means I still think there's gas left in the tank. And here we go. I'm going to give you a final score and then give you a bottom line. We'll move to Q&A. In years where the stock market has advanced more than 10% in the first 6 months, here's what's happened in the second 6 months. So these are second half returns in those years. They have averaged overall about 10.6%, which would put us at the end of this year at 60.38, which is a long way from the 48, and change that the strategists were looking for. And certainly a good way above where we were during halftime. So for 2024, we still believe for investors that markets are a love story. All right, here's our bottom line for 2024, second half. We think that equities will go even higher. And if they close today, we'd be right. In terms of size, we're not buying into the growth scare. We're not buying into the recession. Therefore, we think small caps can outperform large caps in the second half. We think the growth style investing and the value style investing will both do fine, given all the earnings available now to everyone. And in terms of domicile, I think the internationals do fine. There's growth there. They're cheap. The U.S. does fine. I don't think you have to get cute. In terms of U.S. interest rates, short-term interest rates will definitely go lower. On average, that does pull down longer-term interest rates, but we'll have to watch that. It certainly did during the mild growth scare we had a couple weeks back. In terms of the U.S. dollar, if the U.S. economy is surprising a little bit to the downside and the Fed is dragging their feet a little bit, then the dollar could get weaker, I think. In terms of bonds, we expect yields and capital gains to reward bond investors much more than they did in the first half of the year, and it was okay in the first half. And then the primary threat is this, groupthink. So we've got this huge group of people that try and determine the pace and level of interest rate policy, interest rate cuts. Most of them are academic. Most of them are backward looking. The biggest risk is that Jerome Powell doesn't take control. There's a lot of inertia on the Fed. His legacy is at risk. He needs to step forward at Jackson Hole, which happens at the end of this month, and talk about the fact that they need to cut policy to ensure this soft landing continues. And then he needs to take action on September 18th. And then he needs to forecast more action going into the end of the year. If they don't do that, then the Fed can force a fumble through a policy mistake and upend my predictions. But as an optimist, I believe in Jay, and therefore I stick with our optimistic forecast for the second half of 2024. And with that, I came in below an hour, super proud, and I'm happy to take any questions.
All right. Thank you, David, for that great presentation. First question, and we have received this several times, so I wanted to prioritize it. Give us your thoughts around the growing U.S. budget deficit and its impact on the economy and corporate earnings.
So this is a big knotty question. A lot of it's abstract, but here's the way I'll approach it this time. I'm going to give you $1 trillion. Now, you have to put your $1 trillion in a bank somewhere. You can either put it in the United States Bank through U.S. Treasury bonds. You can put it in the European Bank through German bonds, or you can put it in the Japanese central bank by buying yen. We are the reserve currency. The answer to that question 9 times out of 10 is going to be, I'm going to put that in the United States of America. We have the most dynamic economy. We've got the most ships and planes, and we generate all the innovation. China was going to challenge us. Now they're gone. Russia was going to challenge us. Now they're mired in some ground campaign in the Ukraine, and they've been isolated from the global economy. So where are you going to put that $1 trillion? You're going to put it in the United States of America. So the fact that we get to be the reserve currency gives us a little bit of an unlimited borrowing budget. Now, that doesn't mean I like that, but understand that. Also, where we are currently, debt to GDP is actually lower than we were right after the pandemic hit. Why? Because inflation's up 20%, which also inflates away the debt about 20%. It's gross, I get it, but it's true. In terms of the deficits, the reason why the globe continues to trust the United States of America is that we can change our minds with a stroke of a pen, right? Let's say the Republicans take the House, they take the Senate, they take the Oval Office, and Trump decides to raise the retirement age to save Social Security. Well, suddenly the deficit goes down and we become more creditworthy. So the globe recognizes this is the safest place to park your money, even though we've got some boneheaded policies out there. And we have the ability to right the ship should we hit the rocks with a stroke of a pen. So people believe in American exceptionalism, and I know that the media browbeats us that that's all gone. But when you look at the strength of the dollar, it is still there. And I'm not worried about the unmooring of interest rates. I got a little worried about that mid-year last year. And then I was reminded that really the 10-year Treasury rate is not as much a function of those sort of expectations and much more just what is the GDP growth rate and what is the inflation rate. And right now, the GDP growth rate's about 2% and the inflation rate's about 2%. The 10-year Treasury yield is 4%. So I'm not concerned overall about the deficit today. I do think it accumulates into a problem that we've got to deal with later on. And typically they don't have the political will to deal with it until a crisis happens. But we are not on the edge of that. So yes, I worry about it, but I don't think it has an impact on corporate earnings, which is what's driving the market today.
All right, we have time for one more question. A lot of business owners that we speak with are seeing softness in their businesses and in the marketplace. What are you seeing?
So there is softness in the economy, and that is coming from the long and variable lags, right? So the Fed raised policy into restrictive territory, yield curve inverted. Typically that causes some sort of crisis, which causes some sort of recession. This go round, the yield curve inverted, we had a crisis, they covered it up pretty quickly, And so we didn't get the recession that we typically would have gotten as quickly as we would have gotten it. And so now the long and variable lags in the economy are really starting to show up, as I said, from that higher interest rate policy. So we're seeing delinquencies rise on lower income credit cards. That's a concern. We're seeing some small business bankruptcies rise. When I have anecdotal conversations with clients like you, I hear, well, there is some softness out there. I believe that to be true. And if the Fed does nothing, that will continue, that will fester, that will get larger. But for those of you who are business owners, answer this question in your head. If the Fed cut interest rates 2% tomorrow, would that increase the speed of your revenue acquisition? And the answer is yes. I mean, for those of you who are trying to borrow money from banks and they're a little bit this, if rates come down 2%, they'll be shoveling money to you. So I do think we're seeing constriction within the economy. I think it's a Fed decision. I think it's time to remove that restriction. And if they do, the sloughness that you're seeing should abate. So bullish on that.
Thank you, everybody, for joining us. Don't forget to sign up for our weekly email and follow us on social media for more insights.
Thank you, Sean. Y'all have a great day, and appreciate all the work that everybody at Waddell & Associates put in to make this possible. Thank you for tuning in.